Welcome to today's lesson on understanding equities and ownership in companies. In this lesson, we will delve into the world of equities and explore how they represent ownership in companies. Understanding these concepts is essential for investors looking to build a successful investment portfolio. So, let's jump right into the lesson. Segment 1. What are equities? Equities are financial instruments that represent ownership in a company. When you hold equities, you essentially own a piece of that company. This ownership comes with various rights, privileges, and opportunities for financial growth. Let's understand this from the story of Ravi and the fruit stand. Ravi is a young entrepreneur who wants to start a fruit stand business. He needs capital to set up the business, so he decides to offer shares in his company to his friends and family. Each share represents a portion of ownership in the fruit stand. Ravi's friend, Priya, decides to buy some shares. As a shareholder, Priya now has the right to vote on important decisions related to the fruit stand's operations and can also receive a share of the profits as dividends. Ravi's fruit stand becomes a huge success, and the value of the shares increases over time, providing Priya with capital appreciation. Equities can take different forms, such as common stocks, preferred stocks, or convertible securities. Segment 2. Common stocks. Let's start by examining common stocks in detail. Common stocks are the most common type of equity held by investors. As a common stockholder, you have several important rights and privileges. Firstly, you have voting rights, which means you can participate in major corporate decisions like electing the board of directors. Additionally, common stockholders may receive dividends, which are a portion of the company's profits distributed to shareholders. Finally, common stocks offer the potential for capital appreciation. If the company's value increases over time, the value of your common stocks may rise as well. Segment 3. Preferred stocks. Moving on to preferred stocks, they have some unique features and benefits. Preferred stockholders often have priority over common stockholders when it comes to receiving dividends. Take the case of Nisha. Nisha is a conservative investor who prefers stable income from her investments. She invests in preferred stocks of a well-established company called Secure Bank. As a preferred stockholder, Nisha receives fixed dividend payments regularly. While she does not have voting rights, she values the steady income provided by her preferred stocks. Nisha's story highlights the unique features and benefits of preferred stocks. They typically receive fixed dividend payments, providing a more stable income stream. It's important to note that preferred stockholders usually do not have voting rights. Their ownership is more focused on income generation and protection of investment. Segment 4. Convertible securities. Let's discuss convertible securities now. Convertible securities, such as convertible bonds or convertible preferred stocks, have an interesting nature. Initially, they function as debt or preferred equity instruments but can be converted into common stock based on predetermined terms. The conversion feature offers investors the potential to benefit from capital appreciation if the company's common stock price rises. Let's examine the case of Raj. Raj is an adventurous investor who likes to explore different investment opportunities. He comes across a company called Growth Tech that offers convertible bonds. Raj purchases convertible bonds, which initially function as debt instruments. However, these bonds have a conversion feature that allows Raj to convert them into the common stock of Growth Tech. Later, when Growth Tech's stock price increases significantly, Raj decides to convert his bonds into common stock. By doing so, Raj benefits from the capital appreciation of the common stock. However, it's important to consider the potential impact on ownership, as the conversion of convertible securities into common stock can dilute the ownership percentage of existing shareholders. Segment 5. Ownership in companies. Understanding ownership in companies is crucial for investors. Ownership can be divided into legal ownership and economic ownership. Legal ownership refers to holding shares in a company, while economic ownership involves benefiting from the company's profits and growth. As a shareholder, you have rights and responsibilities. You can participate in annual shareholder meetings, vote on important matters, and voice your opinions. Corporate governance and shareholder activism play vital roles in ensuring shareholder rights are protected. Segment 6. Significance of equities in investment portfolios. Equities hold significant importance in investment portfolios. They offer the potential for long-term growth and capital appreciation. By investing in a diversified portfolio of equities, you can spread your risk across different companies and industries. Equities also provide income generation potential through dividends, which can enhance the overall return on your investments. Conclusion. That brings us to the end of our lesson on understanding equities and ownership in companies. We explored the concept of equities as instruments of ownership, discussed common stocks and preferred stocks, and examined the significance of equities in investment portfolios. Remember, a solid understanding of equities and ownership is vital for making informed investment decisions. So, keep exploring and expanding your knowledge in the fascinating world of finance and investments. Thank you for joining us, and we'll see you in the next lesson.